Introduction. Besides terms such as economic growth, investment, and interest rates, you will often hear the word productivity. But what exactly is productivity? How does it work? And why is it so important for our prosperity? In this video, I explain what productivity is, how it drives economic growth, and why credit can temporarily accelerate that growth, but can also create problems. What is productivity? Productivity is the extent to which resources, such as time, labor, and capital, are converted into results. It is a measure of the relationship between the effort put in and the output achieved. In its simplest form, productivity is expressed mathematically as productivity is output divided by input. Output, the goods produced or the services provided. Input, the resources used, such as hours worked, machinery, raw materials, or capital. The more output can be produced with the same amount of input, the higher the productivity. How does it work? When someone works, goods are produced or services are provided. In return, that person earns an income. That income is then spent, and everything one person spends becomes someone else's income. When productivity increases, for example because people work more efficiently, are better educated, or make use of better machinery and technology, more can be produced with the same amount of effort. As a result, incomes increase and spending can increase as well. This is how the economy grows. Is productivity the only way an economy can grow? Well, yes and no. Productivity creates sustainable income growth. But there is also another way an economy can temporarily grow faster. Credit. I explain more about credit in my video, Money versus Credit, What's the Difference? Normally people can only spend what they earn. By borrowing money, however, households, businesses, and governments can spend more than they currently own. Those higher expenditures become income for others, allowing the economy to grow more rapidly. Credit, in a way, brings future spending forward. As a result, the economy can temporarily grow faster than productivity alone would allow. The problems. When the amount of credit in an economy becomes too large, risks begin to emerge. Debt levels rise. The likelihood that loans cannot be repaid increases. Inflation may accelerate, and investments become less carefully considered. After long periods of economic growth, people often become optimistic. House prices rise, stock prices rise. Because of inflation, debts appear to become easier to repay. Banks become more willing to lend money. And because prices keep rising, investing almost seems to guarantee a profit. Meanwhile, however, everyday life is also becoming more expensive. People who mainly rely on their wages and have little wealth can be especially affected. The central bank. One of the main responsibilities of the central bank is to maintain price stability. When the amount of money and credit grows much faster than the production of goods and services, inflation develops. To slow inflation, the central bank often raises interest rates. Higher interest rates make borrowing more expensive. As a result, people and businesses are less likely to take out new loans and are more likely to repay existing debts. I explain more about inflation in my video, What is Inflation? Simply Explained. What happens next? When people no longer supplement their income with new loans and instead use larger portions of their income to repay debt, spending declines. Lower spending means lower income for others. As a result, the economy slows down and may even enter a period of contraction. This is how a period of economic expansion eventually turns into a period of economic contraction. Why don't we rely only on productivity? Productivity is a stable and relatively predictable way of achieving economic growth. As a result, the economy becomes less dependent on debt and generally experiences fewer large booms and busts. Even so, credit also serves an important purpose. Many investments would simply not be possible without credit. Think, for example, of businesses purchasing new machinery, investing in innovation, or training employees. Individuals can also invest in education or buy a home with the help of a loan. So, when used wisely, credit can actually contribute to higher productivity. Conclusion: in the long run, productivity appears to be the most sustainable source of economic growth. Income growth resulting from higher productivity does not depend on ever increasing levels of debt. Credit can accelerate economic growth and make important investments possible. But when an economy becomes too dependent on credit, risks eventually arise. Productivity creates genuine economic progress. Credit can support that progress, but it cannot replace it. My opinion: in my view, productivity is the real engine of a healthy economy. It promises growth with fewer risks, makes a country more competitive, and increases our long-term prosperity. That international competitive position falls outside of the scope of this video, so I will discuss it another time. In my opinion, investing in productivity is always a wise choice for governments, for businesses, and for yourself. Thank you for watching, and as always, don't worry too much. Everything can be overcome with study and patience.